Have you ever stopped to think about what could go wrong in your day? Not the big dramatic events, but the small, seemingly insignificant mishaps. Imagine you are making your morning coffee. The process seems simple enough. You scoop the grounds, you pour the water, and press a button. But what if the coffee machine, a trusted part of your routine, suddenly malfunctions and overflows? What if you, distracted by a phone call, forget to place the carafe under the spout? This small slip-up results in a mess, a delayed start to your day, and perhaps even a damaged appliance. You have just experienced a minor operational failure, a breakdown in a routine process that led to an undesirable outcome. These small failures are happening all around us all the time. They exist in our homes, they exist in our commutes, and most critically, in our workplaces. Think about a busy restaurant kitchen during the dinner rush. A chef misreads an order ticket, sending the wrong dish to a table. A dishwasher breaks down, causing a backlog of dirty plates and slowing down service. A new waiter, improperly trained, enters an incorrect price into the billing system. So what is this invisible force we call operational risk? Let's break it down. Operational risk equals things going wrong inside an organization. It is not about customers choosing not to buy your product. It is not the stock market taking a dive. Instead, it's loss from how you run your day-to-day operations. Think of it as fumbling the ball. Your team has a brilliant game plan, but a player drops the pass, or misunderstands the play. The plan fails. Not the strategy, the execution. That's operational risk. Formally, it's loss from inadequate or failed internal processes, people, systems, or external events. Diagram: people, processes, systems, external events, all pointing to operational risk. Processes: flawed procedures or poor controls like weak ID verification. People: human error or intentional acts like data entry mistakes or fraud. Systems: tech failures, server crashes or software bugs. External events, outside your control. To truly grasp operational risk, let us look at some examples from both our daily lives and the business world. These scenarios show how breakdowns in simple operations can lead to significant problems. In your personal life, consider the process of paying your monthly credit card bill. You know the due date and the amount, but one month, you get distracted and forget to make the payment. This is a simple human error. The consequence? A late fee and a potential dip in your credit score. The process failed because of a person, you, a small-scale operational risk. Now, let's scale this up to a business context. Imagine a large e-commerce company during a major sales event. The company relies on a complex web of systems and processes to handle millions of orders. An operational risk could be a software bug in the checkout system that prevents customers from completing their purchases. This is a system failure. Alternatively, a breakdown in warehouse logistics could lead to wrong items shipped, a process failure. The company faces missed sales, increased return costs, and damage to reputation. Consider a hospital where an employee emails patient files to a personal account, a people risk that can become a major data breach with fines and lawsuits. It is vital to understand that operational risk is distinct from other types of business risk. The most common points of confusion are with market risk and credit risk. While they can be interconnected, their origins are fundamentally different. Financial risks are often taken intentionally, with the hope of generating a return. Operational risk, on the other hand, is a risk businesses try to avoid entirely. It only offers a downside. It is the cost of doing business imperfectly, not the price of a strategic bet. Market risk is losses from movements in market prices, a deliberate exposure. Credit risk is the chance a borrower will fail to repay, but if a bank approves a fraudulent loan because of weak internal checks, the loss is operational in origin. You manage market risk with hedging, credit risk with scoring and collateral, and operational risk with better controls, improved training, and resilient systems. Each requires its own unique set of tools and mindset. Protect the value you've already created. Operational risk stems from specific, identifiable sources, the four horsemen of operational risk. They are people, processes, systems, and external events. They are people. Humans are fallible. Simple mistakes like a typo can lead to loss. It also includes malicious acts like internal fraud, and failures in training, supervision, or understaffing. Processes are the formal and informal procedures that govern work. When processes are poorly designed or bypassed, risk skyrockets. Late quality checks can let defective products pass, wasting time and money. Systems are the technology, hardware, software, and networks we depend on. From full outages to subtle bugs that cause billing errors or breaches. Even physical infrastructure issues can trigger system failures. External events are outside your control. Hurricanes, floods, earthquakes, or man-made events, protests, political instability, or blackouts. The risk is not the event itself, but failing to prepare for its operational impact. You cannot manage a risk you cannot see. The first step is to identify it. This is a continuous process. Ask, what could go wrong here? One powerful tool is the Risk and Control Self-Assessment, or RCSA. Managers and staff map processes, brainstorm what could go wrong, and assess existing controls. They identify key processes and evaluate control effectiveness. Another method is analyzing historical loss data. Every failure should be logged and studied. What was the root cause? What was the financial and non-financial impact? Scenario analysis asks, what is the worst that could happen? It stresses preparedness. For example, simulate a 72-hour mobile banking outage to map consequences. Map customer outrage, media backlash, regulatory scrutiny, and direct financial loss. Use heat maps to prioritize risks by likelihood and impact. Set key risk indicators as check engine lights, server downtime incidents, turnover rate, training completion. When thresholds are crossed, trigger investigation and corrective action. By collecting incidents, analyzing patterns, and running scenarios, you uncover hotspots to fix before they become crises. Identification is the foundation of effective operational risk management. Once risks are known, the next step is to measure them, trying to measure a shadow. Measurement helps prioritize effort. Which risks need immediate attention? Not all risks are equal. Consider likelihood and consequence. Some cause minor disruption, others could threaten the organization. Plot risks on a heat map of likelihood versus impact to see priorities. Green =sign monitor, red =sign urgent action. Use KRIs as early warnings, like a check engine light. It might track server downtime incidents monthly. HR tracks turnover rate as a people risk KRI, and training completion rates highlight gaps in control. Some organizations use historical loss data and statistical models to estimate dollar exposure. This can be complex and data intensive, but framing operational risk in dollars helps allocate capital and reserves. Quantification supports budgeting for controls and holding financial buffers. Whether with simple heat maps or complex models, the goal is clarity and prioritized action. After identifying and measuring risk, the most important step is to manage it. You cannot eliminate risk completely. The goal is to reduce it to an acceptable level. 4 primary strategies: avoid, transfer, mitigate, accept. Avoid. Stop the activity that creates unacceptable risk. Transfer. Shift financial burden via insurance or outsource to specialists. Mitigate. Implement controls, training, and preventive maintenance. Accept. Consciously live with low likelihood, low impact risks. Avoid is used when risk is catastrophic and uncontrollable. Transfer via insurance cushions financial blow. Outsourcing specialized functions transfers operational responsibility. Mitigation examples: 4 eyes approvals to prevent fraud or error. Install fire protection and perform regular preventive maintenance. Regular training reduces human error. Accept when the cost of controls outweighs the potential loss. No one installs a coffee spill prevention system. You accept and clean up. Ensure decisions to accept risk are conscious and documented. Mitigation is the heart of operational risk management. We have journeyed from a simple coffee spill to a complex cyber attack. Operational risk is loss from failed processes, people, systems, or external events. It touches every person in an organization, from boardroom to front line. The person on the line is the best expert on their process risks. Frontline staff know communication gaps. IT staff know system vulnerabilities. Empower people to speak up and suggest improvements. Make risk monitoring a shared, continuous activity. Resilience means faster recovery from shocks. Clear processes and training lead to consistency. This not only prevents loss, it makes the business better. Well-managed operational risk informs better decision-making. It protects reputation and customer trust. Operational risk management is an unending watch kept by all. Face hidden dangers head-on. Make managing how you do things as important as deciding what you do.